In this video, we're going to discuss 5 retirement strategies that anyone can use to retire by 60. As a certified financial planner and the founder of a retirement planning firm, I've helped people all over the United States retire using these non-complicated retirement strategies. Unfortunately, most people are trapped in the belief that they must wait until at least their mid-60s or perhaps even longer before they take that big jump into retirement. But the truth is, being ready to retire isn't about your age, but more about ensuring you have a retirement strategy that focuses on what really matters to you. Now, fortunately for you, in this video, we're going to be breaking down what does actually matter by going through these 5 strategies that anyone can use to retire before 60. The first step that you can take to retire by 60 is to begin investing or saving earlier. One of the biggest components of anyone's investment success is going to be time. It's in fact the most important component. The longer you can have your dollars invested working for you, the greater your returns will be over time. In fact, compounding has been labeled as the 8th wonder of the world. It's just almost like magic how it happens. Now, if you see here on this chart, you can see that in the first few years of the saving cycle, you can see that majority of the money you might have in your account, if you're saving $10,000 per year, is going to be the actual savings. In fact, once you get to $100,000, 78% of that amount is actually going to be your actual savings. Now, the other 22% is going to be the returns. But as you continue to do this over a number of years, you're going to be saving $10,000 per year. You'll find that the majority of your balance actually is not how much you have contributed or saved to your accounts. It's actually going to be how much your returns have been over time. So if you look at that and you see by $1 million in this particular instance, $10,000 of annual savings at a 7% annual interest rate, you can see that 86% of the dollars out of that 1 million is actually market returns and not your savings alone. So this shows you how powerful time and compounding is when it comes to building your wealth to be able to retire by 60. Now, where can you start or what can you do if you still are in this accumulation phase and you're not to 60 yet or not closer to retirement age? Well, the first thing is you have to have a budget around how much you can save each month. So if you earn $100,000, try not to spend all $100,000. You actually need to save a decent chunk of that, 10, 15, perhaps even 20% of your income so that you can begin to build wealth faster and get more money invested into your accounts faster. Something else you can do is take advantage of the 401k if you have one available to you, because there often is a match that could be there that you can take advantage of. That is free money that can be given to you. But then also begin to go outside of that 401k and maybe use a Roth IRA, which you would put after-tax dollars into that account, but it grows tax-free into the future. So your compounding that would happen in that particular account would be happening in a tax-free capacity. But then also think about any additional dollars you can save to a normal investment or taxable brokerage account. That brokerage account can be used in any capacity for any reason, regardless of your age, and there are no additional penalties to take from that before retirement age. We're going to talk more on that in just a second. The next thing is you can just use normal investments. You don't have to go find the next Amazon or the next Apple and pick that particular stock. Just use the basic indexes. Use index funds, ETFs, mutual funds. Use low-cost options that are available to you, and you don't have to do anything fancy. In fact, Warren Buffett often says that the majority of investors should just buy the overall market and stick with it, rather than try to time or beat the market by picking individual stocks. And the final thing that you can do is stay consistent. This might be the most important. Every single month, every single paycheck, however often or whatever your frequency is, make sure that you are doing this consistently. Don't stop and start and stop and start. Building this up over time and getting that compounding going is the key. So the faster that you can get that money in without taking a break is going to be crucial to your long-term success. The second strategy that you can use to retire by 60 is making sure that your investment allocation is appropriate for the stage of life that you're in. If you are not of retirement age or not really even close, stay on the aggressive side of things with stock mutual funds or ETFs to make sure that you're making the most of your hard-earned dollars and having that work harder for you. Also, target date funds are often found in 401ks, and they're designed to get more conservative as you get closer to your retirement date. But this is often maybe not what you're looking for, even if you are in your 30s, 40s, or 50s. You might want to stay more aggressive during those time periods rather than get closer to a 90-10, an 80-20, or a 70-30 allocation, because again, those bonds that are going to be found in that target date fund could cause you to underperform what you are trying to do. So that's for the pre-retirement or accumulation phase of life. Stay aggressive and make sure you're not having anything in your portfolio that could be causing some performance drag. Now, if you are getting close to retirement or perhaps even in retirement, one of the big mistakes that I often see is getting too conservative too quickly, meaning we have too much cash on hand or we have too much in bonds or fixed income on hand, and we neglect the opportunity that stocks still present to us, even as someone who is nearing retirement. So what I would say for folks who are within that 5 years of retirement or even perhaps already retired, in order to have the proper investment allocation for you, I would say that you need to base this on how much you're spending every month and then have some multiple of that in cash and bond bonds, and then the rest should be allowed to be in stocks. The way that I like to do this is build out a bucketed system to where you have 2 years of living expenses in cash or money market. You have 3 years of living expenses in bonds, fixed income, treasuries, anything that's generating income, and then everything else is allowed to be in the stock portion of your portfolio. Now, what this doesn't do is it doesn't follow a standard 60-40 retirement portfolio or a 50-50 portfolio. This is unique because it actually is basing your overall investment allocation based on your specific needs rather than following some rule of thumb. So I like to use these buckets when it comes to retirement, and just know that this will probably make you more aggressive than you otherwise thought you should be in retirement. And the reason for that is because you want your stocks to continue to grow, or your portfolio to grow over time, so that you're beating inflation and you never have this issue of longevity risk, which means you're not going to run out of money in retirement, hopefully. Also, since you're trying to retire by 60, maintaining that aggressive mindset or that aggressive approach while covering your short-term expense needs is going to be important for you, as you're going to be retiring before other people. Therefore, your money will have to last you longer. The third thing that you can do to retire by 60 is know how much you're going to need in retirement from an income standpoint. I find that most people have no idea how much they spend on a monthly basis as they are in the later years of their career, because they most likely are having more money than they've ever had. And so taking an accurate budget every month is not something that's top of mind. So what I would recommend is you have to know how much you spend on a monthly basis in order to be able to build a retirement plan that's unique and specific to you. So I recommend finding out 2 numbers. The first thing is how much do you need to spend to meet all of your basic living expenses, things like your utility bills, groceries, gas, the main things that you have to do to live every single month. That's the first number to find. The second number to find is how much you would like to spend. So for example, this could be $3,000 a month of base spending needs that you have to spend every month, and then your desired spending could be $8,000. So that's a $5,000 difference there. And why I like to have these 2 numbers is because it allows you to operate within this range, knowing that you've got to have $3,000, but you'd love to spend $8,000. During those hard times, maybe the market's gone down, or you've spent more one particular month, or for whatever reason for a large purchase, you can actually pull back on the next month and know that I can still go all the way down to $3,000 and spend that, because that's what my base spending needs are. And then after that, I can go back up to $8,000 if I'd like to. So this range of income need will actually give you some flexibility as you're figuring out how much you can spend in retirement based on your portfolio. Now, that's the next step. You've got to figure out how much I have saved for retirement and how much income will that produce, whether that be through selling off principal or actually having dividends or interest or capital gains come into the account. How much income can my portfolio produce? So we have to test how much our portfolio will support versus how much we're going to be spending and how far off those numbers might be. If those numbers match up perfectly, wonderful. Now, oftentimes they don't match up perfectly, which is okay. Sometimes our spending needs are going to be greater than what our portfolio can produce. But here's what I want to encourage you with. You have to look ahead to the other income sources you might be having in the future, such as a pension. Maybe you have rental income, maybe you have an inheritance coming in the future, but also Social Security. So what I've found, if you're retiring before 60, you're going to be spending a larger percentage of your portfolio in those first few years than otherwise would be recommended. So we often hear about the 4% rule, but the 4% rule is designed to spend 4% of your portfolio for a 30-year stretch every single year for 30 years. Now, whenever we think about this flexibility in spending, we can spend more perhaps in the first 5 to 10 years until those fixed income sources such as a pension or Social Security would flip on in the future. So if you spend more early and less late, maybe that averages out to 4% over a 30-year time frame, but we're often fixated on that 4% number. So what I would encourage you with is a look ahead, think about the other sources of income you could have in the future, and if you're going to be spending a higher percentage in terms of your distribution rate from your portfolio in the first few years of retirement, that might end up being okay. We just have to test that against your plan and make sure that there's nothing too far off looking forward into the future. The fourth thing that you can do to help retire by 60 is be tax diversified. Now, what I mean by this is actually asset location. Asset location is having a different source of income based on how those different pools of assets are taxed. So for example, a traditional IRA or traditional 401k, those are tax deferred assets, meaning whenever you take money from that account in the future, that's whenever you will be taxed on that as normal income. If you have a Roth IRA, any dollars you take from that are going to be tax free. Now, a couple rules have to be met there for every dollar to be tax free, but any contributions that you've put into the account, those can be taken out at any point for any reason, no questions asked. Now, there's this final bucket called the taxable bucket, or just a normal brokerage or investment account, and this one is actually unique. You can take money from this regardless of your age, but you probably end up paying some capital gains taxes whenever you sell something that has grown in value over time, but also you're going to have dividends and interest tax to pay on that that along the way. So you have these different sources of income in retirement, and this is what tax diversification is. So just like we want to be diversified on our investments to avoid any unnecessary risks, we want to avoid tax risk in retirement. Instead of having all of our dollars be taxed as normal income from a traditional account, we want to spread out that risk a little bit and say we want to have some in Roth and some in brokerage accounts. So as you're planning to retire by 60, one of the issues that often comes up for these early retirees is, well, what if all my money is in a traditional IRA and I can't pull from that because I'm not 59 and a half yet? Well, a good solution to that is to have money in a Roth IRA, but also have money in a brokerage account to bridge that gap before you get to 59 and a half. Now, there are some different strategies there to be able to pull money from a traditional IRA, but I want to get into those today. So to make all of that easier though, just go ahead and try to get tax diversified before retiring at 60. That way you have different sources of income to pull from at that time. And the fifth and final way to help you retire by 60 is build up cash. So oftentimes people get to retirement, they have a lot of money in their 401k and they don't have any cash to show for themselves. They have $20,000 in the bank, they've got $1 million in a tax-deferred 401k. Having cash on the sidelines, number one, it fills up that first bucket that we talked about. We want 2 years of living expenses in cash if we can do that. But then also it gives you more flexibility. It gives you some buffer when it comes to markets that are going down perhaps, or the sequence of return risk that comes with retirement. It allows you to pull on something that has not lost value, but it also gives you flexibility and comfort to sleep at night knowing that you've got a certain amount of money sitting in cash that's not invested in the market, that's not subject to any sort of investment risk, and that will give you the confidence you need to pull the trigger and finally retire. So cash is your friend in retirement, but don't get too cash heavy because then you'll start underperforming markets over time and inflation will eat into your cash that you have sitting on the sidelines. So you need to have enough, but not too much, and that's something you can figure out whenever you are building your plan. Now that you know these exact strategies that you can use to retire by 60, you can begin to apply these to your own life and start your journey towards an early retirement. However, there are many small details and nuances that will likely come up in your personal situation that are going to cause problems for you that I've not been able to actually cover here in this short video. So if you want me to actually help guide you to an early retirement, click the link in the description below. It will take you to a page where you can book a completely free consultation call with me, and we can begin to work together and start to build your plan that lets you live out the retirement of your dreams.